Retirement tax planning is complex, and it's common for retirees to pay more than necessary in taxes and penalties. As a CPA, I often field questions about how various investment types, such as 401ks, IRAs, investment accounts, Roth IRAs, pensions, real estate, and life insurance, and how they're taxed when individuals transition from accumulating assets during their working years to withdrawing them for retirement income. Each of these investment vehicles has its own set of tax rules, which can complicate planning. Many individuals do an excellent job of saving for retirement, but the rules change significantly once they retire. Having to learn how all their investment vehicles are taxed and how they integrate with Social Security, Medicare, income planning, long-term care planning, and estate planning make it hard for retirees. Moreover, these rules are subject to frequent changes, making it difficult to stay updated. Understanding these elements is crucial, as a misstep can lead to major financial issues and stress. My name is Kurt Suppi, and I'm here to help simplify things and navigate you through this new landscape of retirement tax planning. Welcome. I'm a certified public accountant and fiduciary financial advisor. With over 3 decades of experience, I've dedicated my career to helping thousands of pre-retirees and retirees navigate the complex world of retirement tax planning. Today, I'll share 10 essential insights into the most common and costly retirement tax planning mistakes, ensuring you're equipped to take the right path to secure retirement. On top of all the tax rules and how they integrate with Social Security, Medicare, and all the other planning areas, our nation is facing an unprecedented fiscal challenge, with the national debt exceeding $34 trillion and rapidly rising interest rates are compounding this problem even more. This debt crisis is even worse than people realize by the impending insolvency of Social Security and Medicare, which are expected to run out of funds much sooner than previously anticipated. These factors are likely to lead to significant tax increases to cover soaring interest payments, which will soon become the government's largest annual expenditure. For retirees, this means not just higher taxes, but potentially reduced benefits. Strategic planning now is essential to protect your retirement savings from becoming overwhelmed by these burdens. Retirees often find themselves surprised by the extent to which distributions from traditional retirement plans are taxed. These withdrawals can cause Social Security benefits to be taxed, Medicare premiums to increase, capital gain taxes to increase, and can even double your tax bracket. Take the case of Karen and Jeff, who had accumulated $1.2 million in their 401ks, planning for a comfortable retirement. Upon retiring, they learned that their income placed them in the 35% tax bracket, which meant their $1.2 million savings would actually amount to only $780,000 after taxes were applied. This significant decrease in their expected retirement funds emphasizes the importance of proactive tax planning to fully maximize and protect one's retirement savings. Karen and Jeff's experience highlights how essential it is for retirees to be aware and manage the tax implications of their retirement plans. For anyone over the age of 59 and a half, if you've owned your Roth IRA for more than 5 years, the growth in all of your withdrawals are tax-free. Yet many retirees have not fully utilized this potential. Efficient transfers from traditional retirement plans to Roth IRAs, especially during post-retirement, can save significant amounts in taxes over the long term. However, many people lack sufficient understanding of these opportunities to optimize their retirement income and minimize their taxes. Proper planning of Roth conversions to maximize tax efficiency is often misunderstood, leading many to convert the wrong amounts. Excessive conversions in a single tax year will increase your tax burden. However, many people fail to convert enough into their Roth IRAs each year, causing them to be underutilized. Careful projections and execution of these conversions are crucial to fully benefit from the tax-free advantages of Roth IRA accounts. For example, Sarah decides to convert $100,000 in 1 year. This large amount pushes her into the 32% tax bracket for that portion of her income. Instead of paying her usual 24% on the converted amount, she now owes 32%, significantly increasing her tax bill for the year. This decision not only costs her more in taxes, but also reduces the amount she can invest tax-free in her Roth IRA. Many retirees are surprised to learn about the Income-Related Monthly Adjustment Amount, otherwise known as IRMA, which affects Medicare Part B and D premiums based on your income level. If your modified adjusted gross income is above a certain threshold, you could face significant surcharges on your premiums. This can dramatically increase your healthcare costs in retirement. Proper income planning and understanding the thresholds for IRMAA surcharges are crucial to avoid unexpected increases in your Medicare costs. For example, John, a 68-year-old retiree who recently tried to optimize his retirement savings by converting a large sum of his traditional IRA to a Roth IRA. 2 years ago, his income was $95,000, but due to his Roth conversion, it spiked his income to $150,000 for that year, unknowingly pushing him into a higher Medicare premium bracket. This year, he was shocked to discover that his Medicare Part B and Part D costs surged dramatically because of IRMAA, the income-related monthly adjustment amount. Instead of paying the standard $210.10 for his new monthly premiums, he now pays $288.40, a 37% increase. This substantial jump, triggered by his Roth conversions, served as a stark reminder of the need for strategic financial planning, especially when it comes to managing retirement income and healthcare costs. Many longtime married couples never plan for the tax implications of transitioning from a joint tax return to an individual tax return, which inevitably occurs when one spouse predeceases the other. The surviving spouse, now filing an individual tax return, could face a lifetime of excessive taxation without proper planning. This often overlooked scenario can significantly disrupt a surviving spouse's financial stability and must be managed to mitigate unexpected tax burdens. Understanding the taxation of Social Security, how to take large capital gains tax-free, and coordinating these with ordinary income taxes from traditional retirement plans is critical. Integrating Roth IRAs can greatly enhance tax efficiency, achieving very low to zero tax rates in the long run for high net worth individuals. However, many fail to undertake necessary planning to coordinate and project taxes for maximum efficiency. The order in which you take withdrawals from your retirement and investment accounts can drastically affect your financial health in retirement. An illustrative example: 2 retirees with identical rates of return and distribution amounts can end up with vastly different financial outcomes based solely on sequence of their withdrawals from their accounts. Understanding when to withdraw ordinary income, capital gains, and tax-free dollars during your retirement can mean the difference between a financial legacy and running out of money prematurely. Simple yet strategic planning can prevent a large portion of your wealth from going unnecessarily to taxes, maximizing your retirement income and legacy. Most financial firms excel in wealth accumulation and generic retirement planning, but often avoid giving tax advice, directing clients to a CPA instead. Working with separate advisors for your investments and tax planning can lead to a disjointed financial strategy. It's a common scenario. Your financial advisor tells you to consult your tax advisor and vice versa, but neither is fully aware of the other's plans. This can result in missed opportunities and avoidable financial errors. To prevent these issues, it's crucial to have a cohesive strategy where your financial planning and tax advice complement each other. This unified approach not only prevents costly mistakes, but also boosts the effectiveness of your retirement. For example, Michael received advice from his financial advisor to convert a significant amount from his traditional IRA to a Roth IRA, aiming to benefit from lower taxes on future withdrawals. He proceeded with the conversion, which increased his taxable income substantially for the year. Simultaneously, Michael's CPA, unaware of this conversion, was planning to recommend a series of charitable contributions through a donor-advised fund to reduce his taxable income. Because the financial advisor and CPA did not coordinate, Michael missed out on the charitable contributions, leading to a higher tax bill and unexpectedly pushing him into a higher bracket for Medicare IRMAA, the income-related monthly adjustment amount charges. This lack of communication not only escalated Michael's tax liabilities, but also increased his healthcare costs significantly. Life insurance is frequently marketed as beneficial for tax planning, but the reality can be less rosy. High commissions, steep fees, and less than transparent sales pitches about these products can lead to poor financial decisions. These products often underperform compared to their sales illustrations, particularly when policy loans or high costs lead to depleted returns. Being well-informed and skeptical of too good to be true pitches is crucial to making wise investments that truly benefit your financial future. There are a lot of life insurance salespeople out there disguising themselves as tax planning professionals. We've covered a lot of information here on the top 10 retirement tax planning mistakes. And you have two paths to choose from. Path 1, do all of this on your own and hope you don't get lost. Path 2, meet with one of our experts in a no-cost, no-obligation virtual meeting and let us help direct you on the best financial path. Take charge of your financial future today by exploring what your options are. Click on the link below to schedule your no-cost, no-obligation virtual meeting. Our virtual meeting is tailored specifically to you. We'll review your taxes, retirement income, investments, and retirement goals to pinpoint exactly what steps you need to take next. There's absolutely no cost, no obligation, and no sales pressure. You have nothing to lose and will help you make the most of everything you've learned today. Set up your virtual meeting now. Empower yourself with knowledge and expert guidance to ensure your retirement tax planning is on the right path. Click on the link below to schedule your no-cost, no-obligation virtual meeting today to take the first step towards securing a financially sound retirement. Our team of seasoned experts are looking forward to meeting you.